Once again, welcome to Real Turkey YouTube channel. This is your presenter Atilla Yeşilada. Today we're going to talk about the Fed taper or Fed reducing asset purchases and how that may impact Turkish assets and indeed politics. Essentially, Fed is changing monetary policy. What does it intend to do? Since this issue is rather technical and probably not too familiar to those who don't do economics professionally as we do. So I'm going to give you a long explanation about what tapering is and why its reverberations go beyond the United States to the global markets. And we have a very bad experience with a similar event when Bernanke said, we're thinking of reducing asset purchases. This happened in the summer of 2013 and led to taper tantrum. Yes. There are a lot of business specific words here, which I will explain. What is taper tantrum? And then in the second part of this video, we're going to move on to Turkey. Turkey is one of the most indebted developing nations, and most of that affects that is in dollars. So there is a reason to ask if changes in the value of the dollar or changes in the 10-year US government bond yield. Let me just lower the headroom here. That's what my producer tells me. Let me repeat myself. So the question is, will the Fed policy change also have an impact on the value of the American dollar and the 10-year American government bond yield? The 10-year American government bond yield is most widely used as a benchmark to price other bond issues. So Turkey has a lot of foreign debt, also domestic debt, some of which is very sensitive to dollar movements and movements of American interest rates. And we need to ask, will the Turkish economy and financial assets be hurt by Fed taper? But first of all, we need to understand what taper is. And just a second, did I put it here? Nope, wait a second. I will find it. Excuse me. Okay, here we go. I have essentially, instead of using my own words, copied the explanation of Fed taper from reputable financial press outlets and provided the links below. Essentially, since 2008, Fed is pursuing what we call non-traditional monetary policy or quantitative easing. Fed usually reduces interest rates to stimulate the economy or to pull it out of a recession. But what do you do as a central banker if the nominal interest rate is zero? Japan and European Central Bank have chosen the path of charging negative interest rates. That is, if you deposit money with the European Central Bank, you have to pay money to them to safekeep that money. Fed decided that's not good for the American markets, in particular because Americans have invested huge sums in what we call the money market funds. So Fed essentially, instead of lowering the interest rates to the negative quadrant, decided to expand its balance sheet by buying government bonds and mortgage securities that are circulating in the market. That pours more money, more dollars into the market, and by reducing the available supply of long-term bonds and mortgage securities, reduces interest rates. And of course, if both short-term and long-term interest rates go down, consumer durables purchases and private fixed investment will be stimulated. Tapering is the gradual slowing of the pace of Fed's large-scale asset purchases. Probably Fed will start tapering, that is reducing the $120 billion worth of assets it purchases each month by January 2022, and then in successive months, probably every quarter, it will further reduce the size of its asset purchases, so much so that by the end of 2022, Fed will not be buying new assets to expand its balance sheets. And if all goes according to the plan, Fed will start raising interest rates in 2023. Something like that happened several times in the past, and each of these episodes there was a turmoil not only in the American markets but in global risky assets markets as well. The most notorious of this happened in 2013, which we collectively call the taper tantrum. That's when the then central bank head Bernanke said, I think we're going to reduce asset purchases gradually. The market didn't really understand what that meant and feared that Fed will be raising interest rates soon. As a result, a sell-off or panic started in all the global markets, which lasted, depending on the market, from 6 to 13 weeks. Turkey at that time was dealing with the Gezi uprising, a social and peaceful public protest movement to protect the trees in the main square of Istanbul called Taksim, and Gezi is the name of the park where the government intended to cut the trees. So Turkey had a double whammy, as a result of which Turkish lira depreciated significantly, while Turkish bond yields rose, and Erdogan lost a lot of reputation as a result of this event. So we're extremely worried that something like that could repeat. Though, of course, history never exactly repeats itself. Compared to 2013 and then a smaller episode in 2018, today the developing nations, which we call emerging markets for sake of simplicity, are economically in much better situation than they were in 2013. Again, in financial language, we call this fewer emerging markets are fragile to external shocks. Now, all of this I'm going to put in plain speech. Fed tapering asset purchases usually raises global interest rates and causes the currencies of fragile nations to depreciate. Now, let me remind you, while there are good theoretical reasons to think that this is the correct assertion, exactly the opposite may happen. Because remember, markets don't just price Fed tapering. At the same time, they are looking at geopolitical risks, the conditions in the American and world economy, the going rate of inflation, energy prices, etc., etc. So these are theoretically correct assertions and they have a good correlation with actual events, but there is no guarantee that every time Fed reduces asset purchases, there will be turmoil in the global markets. But it's fair to say that countries with high current account deficits, low interest rates, that's low vis-a-vis that nation's inflation or vis-a-vis American interest rates. When their central banks have low FX reserves, a term I will define in a few minutes. And of course, if a nation has strong trade links to the USA, taper will hurt them. The last requires some explanation. Obviously, Fed reducing asset purchases is not a major hit for the American economy, but to the extent the dollar appreciates and American bond yields rise, it does have a moderate deflationary or recessionary impact. Since United States is number one or number two importer of the world, if the United States economy slows down, then those nations that export a lot to US, i.e. those with strong trade links, will be hurt by the taper. So this is Fed taper. And remember the second paragraph here, which countries are most likely to be hurt? It is those with high current account deficits, low interest rates, low FX reserves, and strong trade links to US will be hurt. Now, in case of Turkey, Turkey doesn't currently have very high current account deficits as measured a percentage of the GDP. Turkey will probably close the year with a current account deficit to GDP ratio of 2.5%, which is considered sustainable. So it means it is okay. And we don't have very strong trade links to the United States, but 50% of our exports go to the European area, EU. Not to complicate the exposition here, I didn't mention that the European Central Bank too has started the tapering process. It too signaled its intention that it's going to reduce its monthly asset purchases, which could lead to Euro Turkey rising higher. And of course, that's bad for Turkish assets. It's bad because it's inflationary. It is also bad for Turkey's imports, which may decline. But Turkey has, let me just put this table back, Turkey has very low interest rates, not compared to Fed rate, which is zero, but compared to its inflation. Currently, the central bank's policy rate, which is the base rate for the country, is 19%, whereas CPI inflation as of August in an annualized terms was 19.1%. So we already have negative interest rates. Additionally, compared to peer emerging markets, our rates are extremely low too. Many of the other countries, such as South Korea, Russia, Brazil, South African Republic, have lower nominal interest rates, but since their inflation is much lower than the going interest rates, their real rate is higher than Turkey. So we have a double disadvantage in case Fed taper starts another taper tantrum, in the sense that we still remain fragile in terms of level of interest rates. Also, our FX reserves are low, and we are a very dollarized country. Now, let's go over these one by one. First of all, we have huge amounts of domestic and foreign debt. We're not unique in this among developing nations, but our debt is mostly in dollars. Let me show you. This is a table from Yatırım Finansman Investment and Securities. Here, the chart may be a little bit read to hard, but Turkey has $165 billion worth of foreign debt maturing in the next 12 months. Some of it is short term, some of it is long term. So, anytime global interest rates rise or American dollar appreciates vis-a-vis the Turkish lira, the servicing costs of the foreign debt increases, in the sense that the companies who borrowed these dollars generate revenue in Turkish liras. And if dollar appreciates against the Turkish lira, their interest payments and principal payments will take up a higher portion of their cash flow. So, $165 billion is nothing to laugh at, and Fed taper would start hurting Turkish private sector debt holders probably sometimes around mid-2022. Let's look at domestic debt. This chart is in Turkish. I'm sorry, I can't find one. This is the government debt. It's not entirely domestic debt. Its size is about 200 trillion liras, or roughly, what, $180 billion. But the green portion is debt denominated in dollar or euro terms. So, once again, if the dollar and or euro appreciate against the Turkish currency, and since the Turkish treasury collects taxes in Turkish lira, the share of the budget going to interest service on FX loans will increase, which means there will be fewer funds left for schools, hospitals, paying civil servants, etc., etc. In this sense, Turkey is a highly indebted country. Both the private and the public sector are highly indebted. Usually, when Fed tightens financial conditions, which is another word for asset purchases, the reducing asset purchases, or global interest rates rise, money flows out of emerging markets. Let me just show that. Just a second. I forgot to show that. Yeah. Why is Fed tapering bad for emerging markets? I'm rolling back the tape. I'm sorry. This is from Brookings' paper. Almost in each instance where Fed changes policy towards tightening, that's printing less money, emerging markets have lost value. Some of these episodes lasted very few weeks. Some of them, as I've said, as in the case of 2013, lasted up to 13 weeks. Now, in case Fed actions or the actions by European Central Bank lead to a withdrawal of capital from a nation like Turkey, of course, the central bank steps in. It's the lender of last resort. In that sense, when investors are pessimistic about the future of the emerging markets, they look at a country's FX reserves. You see, these are the nominal values of uh, Turkey's net FX reserves. They are roughly $30 billion, uh, and compared to an annual debt rollover of $165 billion, that's extremely low. The IMF rule of thumb is that for a country to be considered strong or resilient, central bank's gross reserves must be equal to 1 year's worth of foreign debt rollovers. Let me run the numbers by you again. Turkey has $165 billion worth of foreign debt to roll over in the next 12 months. Its net reserves are $40 billion or so. Its gross reserves are about $120 billion. So, no matter which metric you consider, which criteria you consider, Turkey is still fragile. There is another problem here. Turkey is a highly dollarized country. Here you see Turkish individual savings, and most of it, more than 50%, is in foreign currency or gold, which is also priced in foreign currency. So, if global interests rise, banks need to pay higher interest rates on these deposits, which reduce their profits and which reduce their incentive to make loans to businesses. So, in that sense, it is also bad. Another thing is that Turks have so much of their wealth invested into FX deposits that if there's a financial panic, which is if Turks think that Turkish banks or the Turkish government will not be able to make good on its promises to pay back these FX deposits, they may withdraw them from the banking system. If you remember American history or even European history, you may remember that bank runs were an important contributor to the Great Depression. Banks have to shut down when every customer lines up in front of the uh, cashier's desk. So Turkey is in an extremely fragile situation. Okay, after all this technical explanation, what will happen? Well, first of all, Fed taper is not like draining the pool of liquidity, of dollars. It's more like the pool evaporating slowly. In the first few months, except the initial shock, the psychological effect of Fed saying, well, pay attention, no more ample money. It's going to get harder from now on. There will be a psychological sell-off. But the actual physical impact in terms of dollar scarcity or the demand for dollars exceeding dollar supply will happen much later in 2022 as tapering advances. And that's when countries like Turkey will be really hurt. How will they be hurt? As I've said, global interest rates will rise. The government will have to pay higher interest on its debt, both at home and abroad. And private sector companies who hold FX debt will have to pay higher interest rates or will have to pay off their debt, which means their balance sheets will shrink and they will have fewer funds left to employ more people and to expand their business. So it's also recessionary in Turkey's case. In the worst case, when there is a global panic, as I broadcast this video, there was what we call a global panic or contagion triggered by China's huge real estate trust or real estate asset management company Evergrande. Contagion is when a negative event in a particular market hurts other markets which are in no way linked to the source, to the epicenter of the earthquake. And contagion is always a problem in a country like Turkey because, we're considered to be one of the most fragile and most unpredictable in terms of financial investments. So I can safely say that when Fed starts the tapering process, Turkish lira strength will be over. Turkish lira will weaken. How much it weakens depends on whether Erdogan, our president, instructs the central bank to cut rates despite the headwinds from the global markets, or remains patient and allows the central bank to raise rates. Knowing Mr. Erdogan will probably enter the maelstrom by lowering interest rates, which would reinforce the damage to the Turkish economy and assets. Also, Turkish deposit rates, loan rates, and bond yields are very likely to increase as 2022 advances, which is bad for the economy. And it's also bad for the Istanbul Stock Exchange. Usually when interest rates or bond yields rise, people pull money out of the stock exchange and place them in fixed income assets. And finally, God knows why, but Turks judge the soundness and performance of their economy by the exchange rate. So, all else may be going wrong, but if Turkish lira is gaining value against the dollar and euro, Turks say, aha, the economy is going well. And of course, who gets the credit? The government. In the adverse case, when Turkish lira is depreciating for one reason or other, sometimes it's because of climate change or energy prices rose and government has no fault. They blame the government. So, if Fed tapering leads to a higher value of the dollar vis-a-vis EM currencies and Turkish lira, then there also will be a political shock. Already, there are rumors of early elections in Turkey about which I will shoot a video, and Turkish lira has been rattled by the Evergrande crisis. If Turkish lira continues to depreciate again, as it did in 2018, when Trump threatened to destroy the Turkish economy, roughly 40% depreciation, inflation will increase rapidly, Turkish economy will come to a standstill, and the voters will hold Mr. Erdogan responsible. So, I think that's the entire exposition. Let me just summarize it in a few brief sentences. Fed will certainly start reducing asset purchases in a few months. And barring major black swan events in the American economy, there will be less dollar liquidity as the year 2022 advances, and finally, in year 2023, Fed will start raising interest rates. This process, called monetary tightening, is usually bad news for emerging markets. Emerging markets, even though they're all put in the same basket, have different characteristics. For instance, Russia is a net exporter, China has a net current account surplus, so they will be less hurt. But countries like Turkey, which hold a lot of dollar debt, will definitely be hurt. And the impact will increase in severity as Fed advances with tapering. This is bad for the Turkish economy because it reduces private fixed investment and it reduces funds available in the budget to distribute as public infrastructure or public spending. And finally, since Turks judge the soundness of their economy by the strength of their own currency, it's quite possible that if the Turkish lira depreciates, Mr. Erdogan will take the blame for that. This has been very long and very technical, but hey, it is the primary topic in Turkish financial markets and among those investors who invest in Turkey. So I thought you should be informed about it. Thank you very much for your comments and watching Real Turkey channel. If you liked this presentation, please share it with your friends who may have an interest in Turkey, be it academic or business-wise. This is Atilla Yeşilada saying goodbye from Istanbul. All right.